What's up, everybody? This is Sunko, the Korean bro. Today is 2023, January 4th. Hmm. I'm back again. Let's see. Okay. Hmm. Uh, when do we have FOMC meeting this month? Hmm. First, let's filter event. Hmm. The only event that I'm going to look at is United States event. Okay, so let's see. Alright, this week we have FOMC meeting minutes Wednesday, January 4th. So tonight we have JOLTS job openings and Thursday initial jobless claims, crude oil inventories. On Friday, non-farm payrolls, unemployment rates. Hmm. Okay. Hmm. First things first. Okay. Hmm. Top 5 growth stocks I'm buying to kick off 2023. General Electronics begins a new chapter. Down 25%. The surefire passive income powerhouse is a no-brainer buy for 2023. Twilio, Zoom, and other cloud communication stocks are buy for 2023. Three growth stocks that haven't been this cheap in years. Hmm. You okay? Hmm. Hmm. One magnificent growth stock to buy like there's no tomorrow. Kathy was buying these top growth stocks. Okay. Four Warren Buffett stocks. Okay. Four beaten down tech stocks. Mm. Okay. One by one. We got a lot of articles tonight. Okay. Mm. After taking a beat in 2022, many growth stocks are trading at appealing levels for long-term investors. Investors should focus on companies that can grow sales and profitability in 2023 and beyond. After a brutal 2022, there are many long-term deals to be bought. After more than a decade of incredible outperformance, uh, growth stocks badly underperformed the following mock in 2022, with the Federal Reserve bringing the era of ultra-low interest rates to end. Value stocks are back in fashion. Alphabet, we got Alphabet, ASML, Crocs. Okay, first, let's see. Alphabet, yeah. There's no shortage of worries for Google parent Alphabet right now. There are antitrust issues. It has been fined repeatedly by regulators in the European Union, the US, and elsewhere. So they had to pay fine. But it's still doing okay. Google has a new competitor on its hands with the explosion in popularity of OpenAI's ChatGPT and the advertising industry through which Google monetizes its core internet search business has slowed significantly due to global macroeconomic problems. So Alphabet is also struggling with macroeconomic problems. Okay, Alphabet's growth and the profit margins took a bit heat in 2022 as a result. Specifically, mm, Alphabet's revenue grew just 6% year over year in quarter 3 2022. Its operating profit margins were 25%. That compares to 13% revenue growth and 28% operating profit margin just 3 months prior. Clearly, the global economy is a headwind for Google. Nevertheless, there's still a lot to like about this tech giant. While digital ad sales have hit a snag in the past year, the growth of that market segment is still a long-term secular trend. I expect Alphabet's revenue and profit margins to eventually rebound. So their revenue and profit margins have gotten a bit have gotten hit recently in quarter three especially, but then because of ad sales. Mm. And they also were influenced by macro headwinds, especially ad industry um, was influenced by the most. So they are not exception. Uh, but this author really believes that it's got a lot of potential, so it's going to rebound soon. Okay. And next we have is ASML. ASML currently has a monopoly on the extreme ultraviolet technology that the chip makers such as Taiwan Semiconductor Manufacturing use to manufacture their most advanced logic chips. So TSMC also uses technology that's used by ASML. And ASML is like the only one company that can produce this kind of technology. So they're like dominant one. Okay. Anyway, uses to manufacture the most advanced logic chips. As a result, ASML has been a top chip growth stock in recent years. But the company has a plenty left in the tank. The semiconductor industry is expected to go from about $600 billion a year in global sales in 2022 to $1 trillion a year or more by 2030. Additionally, more mature chips are increasingly being produced using the advanced machines ASML offers. ASML's new baseline projections for growth imply an average sales growth rate of 18% from now until 2025 and 12% average annualized sales growth from now until 2030. Because he plans to repurchase stock along the way, ASML's earnings per share could grow at an even faster pace than revenue each year. Shares of this cheap fabrication equipment litter trade for nearly 23 times trailing 12-month free cash flow. That's a premium price, particularly if the world slips into recession in 2023. But given the long-term outlook, ASML looks like a great value. So, okay, TSMC is the one that Warren Buffett invested into, and TSMC uses technology produced by the company named ASML, and ASML it's expected to grow 18% a year, and it's expected to grow 12% average until 2030, uh, year over year. Because of macro headwinds, it's gotten a bit low. The stock price is gotten a bit low, so it looks like a great value from author's point of view. Okay, and the one we have is Crocs. Hmm, let's see. Crocs stock chart from the last couple of years is a bit misleading, but the company is still doing just fine. After an absolute explosion in sales during the early pandemic, the form cloud maker is more than holding on to its greater sales levels. It's building on them when excluding the effect of currency exchange rates. The Crocs brand grew 20% year over in quarter three 2022, driven by a massive 82% rise in sales in Asia. Its acquisition of casual shoe brand Hey Dude is also paying off. As a standalone business, Hey Dude would have grown 87% year over year in the last quarter. Hey Dude's growth and Crocs international expansion have given management plenty of optimism about the next few years as they try to sustain an average double-digit percentage rate of sales growth. Lulumon, we have Fortinet, cybersecurity. Let's look at cybersecurity company, not Crocs one, Fortinet. Thanks to the efficiency that cloud computing offers, the world is rapidly moving to digital first work environments. But with those new efficiencies come trade offs, among them security risk. Fortinet has long been a leader in cybersecurity hardware and software, and it's enjoyed a fresh growth phase. In recent years, thanks to the massive network upgrades necessitated by the pandemic. One secret to Fortinet's success and something that differentiates from a lot of other cloud-based security companies is that it designs the company chips, custom chips using the network security hardware it sells. These chips are consistently ranked best in class. The real beauty here is that after Fortinet lands the hardware sale, the customer turns on the attached software services, which drives its recurring revenue streams. The result, the company expects to average annual revenue growth of about 22% through 2025. Average annual revenue growth about 22% through 2025, while maintaining operating profit margin in mid 20s to high 20% range. Since the company generally uses some of its profits to repurchase stock, earnings on per share basis should expand much faster than sales for the next few years. Fortin is trading at 34 times trailing 12-month free cash flow now, making it a real value if it can deliver on its goals over the next 3 years. We already covered the Fortinet and HTML, Alphabet. So we'll just skip. General Electric beginning a new chapter. Markets looked poised to move modestly higher Wednesday morning. General Electric's share price fell sharply due to the spin-off of its GE healthcare unit. Investors hope the combined value of both stocks will be greater than GE's value previously. GE Healthcare, okay. Stock in General Electric traded at around $67 per share on Wednesday morning. That was down from the nearly $85 per share closing price on Tuesday afternoon, as the new value recognizes the fact that a piece of the company will become available to investors as a separately traded stock. GE announced Wednesday morning that the spin-off of its GE Healthcare unit is now complete. The new company will start trading on the Nasdaq stock market under the ticker symbol GEHC, while the remaining parts of General Electric will still be available on the New York Stock Exchange under the GE ticker symbol. Hmm. Not this one. Let's go to the next one. Union Pacific. Hmm. What is Union Pacific? Union Pacific is a well-rounded dividend stock to own over the long term. The new year is a good time for investors to reevaluate their portfolios to ensure they are on the best path toward financial well-being. A relevant quote worth revisiting is the one from a Warren Buffett: "Price is what you pay, value is what you get." I think it applies perfectly to the state of the stock market right now. There are plenty of safe stocks that are excellent sources of passive income for 2023. Those like Coca-Cola, PepsiCo, and McDonald's are likely to do well in a recession because demand for their product isn't as sensitive to economic cycles. But just because these stocks are safe doesn't mean they are compelling buys now. All three of these companies trade at a price earnings ratio above 25, representing a premium to the S&P 500. Meanwhile, Union Pacific has equally strong fundamentals as those leading consumer staples company, but at a far less expensive valuation. Here's why it's a no-brainer buy for 2023. But let's see, Union Pacific. So specifically, he mentions three examples: McDonald's, PepsiCo, Coca-Cola. Uh, they are resilient, especially in recession. But Union Pacific, the company is also mm, I'm not sure if it's as resilient as others already mentioned above, but we'll see what that is. Uh, the railroad industry of today is consolidated among a handful of players that each has close to a regional monopoly, giving railroads wide moats even if volumes fall in a recession. Not only is Union Pacific the largest North American railroad by market capitalization, but it is also arguably the best run. Useful metric for determining the efficiency of a business relevant to its peers is the return on capital employed. Union Pacific's ROCE of 17.8% is near a 10-year high, and it's the highest of its peer group. Hmm. Okay, a useful metric for determining the efficiency of a business relevant to its peers is the return on capital employed. Union Pacific's ROCE of 17.8% is near a 10-year high, and it's the highest of its peer group. What that metric tells us is that for every $1 of capital that Union Pacific employs, it expects to generate $1.18 in earnings before interest and taxes. Considering Union Pacific invested over $35 billion in improvements over the past decade, the high ROCE shows that these investments are paying off. Hmm. Union Pacific. Union Pacific is railroad company, um, which has great capitalization. How can I explain this? Mm, great market capitalization. Okay. Twilio, Zoom, and other cloud communication stocks are buy for 2020. Zoom is cheap by some metrics, but it needs to figure out how to reignite revenue growth. Twilio is still growing, but it needs to dramatically improve its profile. Cloud communications business have flaws, but present lots of upside if they can fix certain issues. Okay, let's see how they evaluate. If you like the cloud communications industry in 2022, not much has changed for long-term prospects in 2023. Cloud communication companies, Zoom Video Communications, and Twilio were left for dead in 2022. Zoom fell more than 60% on the year. Twilio more than 80%. The reason a bear market that flipped investors' collective focus from growth and momentum to bottom line valuation. At this point, Zoom and Twilio don't fit into either the explosive growth or the value stock category. It has its flaws and associated risk even after enduring a brutal sell-off. However, if you like cloud communication stocks like these a year ago, there are even more reasons to like them in 2023. Let's see. Zoom, the first company we have is Zoom. Zoom revenue growth has stalled out as of late as it continues to struggle with departing individual and small business subscribers. Paired with a record run in the US dollar, it's masking Zoom's double digit growth as it keeps picking up lots of new large business customers. Hmm. Revenue is expected to grow just 3% year over year in quarter fourth of fiscal 2023, the 3 month period that will wrap at the end of January 2023. With net income margins under pressure from these effects, Zoom deserves to trade at its current valuation, 30 times trailing 12-month earnings per share and 18 times trailing 12-month free cash flow. The difference between Zoom's thinning net income and robust free cash flow is a rise in employee stock based compensation. CEO Ari Won and the top team know this is a critical line item the market has grown hyper focused on and has already taken steps to mitigate the issue. Hmm. A share repurchase program is in place to offset the high rate of stock based compensation. Zoom repurchased $991 million worth of stock through the first 9 months of its current fiscal year. Zoom also has nearly $5.2 billion in cash and short term investments, zero debt. A war chest you can use to its advantage after the market has punished the cloud stocks of all sorts. Despite stock price pain, cloud computing should continue to grow at a rapid pace, more than 20% year over year in 2023, according to researchers. Gartner, cloud-based apps like Zoom are expected to help lead the drive higher as large organizations start to replace legacy IT spending with more nimble and profitable cloud processes. Zoom is far from dead. On the contrary, with just a few tweaks, Zoom could have a lot of upside from here in 2023. And next one we have is Twilio. Unlike Zoom, Twilio has remained a briskly growing business this past year, a provider of cloud-based communications infrastructure. Think messaging that other apps utilize to stay in touch with customers. Twilio has patched together critical services that have been in high demand. Organic revenue, which exclude acquisitions, was up 32% year over year in the third quarter, despite had one similar to what Zoom has been facing, like a strong US dollar. Macroeconomic concerns are starting to catch up with Twilio, although CEO Jeff Lawson and company withdrew previous guidance for average annual organic growth of at least 30% for the time being, as inflation and war in Europe throw to expansion. Quarter four revenue guidance implies year over year growth of just 18 to 19%. The real issue the market has with Twilio, though, is incredibly high stock based compensation to employees. $793 million worth over the past 12 months. That is the primary reason for Twilio's massive unadjusted net loss of $1.32 billion. Incredibly high stock based compensation to employees. Okay. Hmm. Hmm. Okay, three growth stocks that haven't been this cheap in years: Tesla, Salesforce. Hmm. Invite, what is Invite? After taking a beating last year, is now the time to load up on these stocks? Invite, NVTA. Let's see. Diagnostic company. Genetic testing is growing in popularity with the 2020 US market worth just over $4 billion. So, get genetic company. Okay, get it. Salesforce. Okay, let's look at Salesforce. Salesforce. Okay. Mm-hmm. Hmm. Interesting. Okay. Salesforce. Salesforce is stock that you might expect will be struggling this year since advertising spend is down and companies are cutting back on expenses. Among Salesforce's diverse business segments, advertising plays a significant role, and its business centers around its customer relationship management solutions. But one expense that is usually among the first to go when companies are concerned about a recession is marketing. Mm. However, hmm, however, that doesn't mean Salesforce's business isn't growing. Mm. Sales are up, but the problem is that the growth rate has slowed significantly. Growth rate. Sales are up, but the growth rate has slowed significantly. Okay, things may not get worse. Uh, Things may get worse for a company before they get better, with a recession potentially on the horizon this year. At a forward price to earnings multiple of 23, Salesforce stock is still expensive compared to the average stock on the S&P 500. It trades at 17 times its future profits. Still expensive compared to the average stock on the S&P 500. Salesforce stock hasn't traded this low since 2018, but I still wouldn't buy right now given the challenges it had. Plus, with the company in the midst of a change in leadership and Benioff taking over as solo CEO, there's some added uncertainty in the mix that makes it even easier to justify not buying shares of Salesforce just yet. Investors are better off taking a wait and see approach with the stock. Okay. Tesla. For a long time, Tesla looked like a stock that could do no wrong. Tesla. Oh, awesome. Oh. Hmm. Okay. The electric vehicle maker was popular by with retail investors and even as growth stocks were in free fall last year. The bullish didn't really come off for sale Tesla stock until CEO Elon Musk bought Twitter. Since October 27, when he took over at Twitter, shares of Tesla nosedived 52%. During that time frame, the Nasdaq Composite declined a modest 3.8%. Investors may have grown concerned about Musk's competing priorities. Mm. Tesla's business itself um, hasn't been doing badly, as sales totaling $21.5 billion in its most recent reported quarter. We're up 56% year over year. Net income of $3.3 billion also doubled from a year ago. While the results are good now, the danger is that Musk may be overselling just how autonomous his vehicles are. In September 2022, there was a class action lawsuit launched against the company, alleging that the company's vehicles are nowhere near being fully self driving and that Tesla advertising has been deceptive. Okay, there's been a lawsuit issue. Okay. People call it deceptive because he says that it's fully self driving, but oh, it turns out it's not. Hmm. Class action lawsuit. What's even more noteworthy is that one of the large automaker in the world, Ford Motor Company, has effectively given up on the dream and is no longer pursuing making fully autonomous vehicles. Hmm. Investors aren't buying the hype anymore, and even Ford Motor Company also gave up on fully autonomous driving. The stock is trading today at a forward P/E of 24, which is a bit expensive, but a far more reasonable multiple than in the past. Hmm. When Tesla wasn't generating much in the way of profits and its earnings multiples were in the triple figures, Tesla stock hasn't traded at this low of a price since August 2020. But when more headwinds possibly on the way due to a weakening economy, Tesla is another beaten down stock. I wouldn't just buy it. Hmm. Musk adds some extra volatility to it as an investment that I would rather just do without. Hmm. Amazon, from books to global domination, Microsoft $1 trillion store with billions of customers. Let's look at Amazon first. Amazon arose from humble beginnings. Founder Jeff Bezos was trying to revolutionize retail by proving he could sell books online. Not only did he and the company succeed, but it's now the largest e-commerce company in the world, with millions of products on offer. Hmm. But that's not the only industry he helped pioneer. Hmm. In 2006, Amazon had built out a large IT infrastructure service to help its customer e-commerce efforts and had an access capacity which it began offering to other businesses, making it one of the first commercial providers of cloud computing at scale. Fast forward to today, Amazon Web Services is the largest provider of cloud services in the world, with hundreds of solutions on offer and at $76 billion in revenue over the last 12 months. In true Amazon fashion, it continues to aggressively expand, The company has a booming digital advertising business where it's monetizing its flashy website, Amazon.com, which generate 2.6 billion hits per month. And Amazon's opportunity to sell ad spots on its e-commerce website will continue to grow as it dives deeper into streaming through its Prime platform. Rumors are swirling that it's working on a standalone app just for its live sports streaming, which already include a hot property like the NFL's Thursday Night Football. Amazon stock listed publicly on May 59.97 at $18 per share, so an investment of 500, about $928 in today's dollars. Back then, would have purchased nearly 27 shares. After adjusting for the company's four stock splits, you would have a 6,480 shares today with a split adjusted cost basis of about 0.075 per share. At Amazon's current stock price of $84, your initial $500 outlay would be worth a whopping $545,486 today. Okay. Among the Dow Jones Industrial Average 30 components, there are five incredible digits beginning to be bought in the new year. Walt Disney, Johnson and Johnson, Intel, uh, Walgreens Boots Alliance, Visa. Hmm. Billion for Session Visa has been benefiting from increased credit card use as the US pays. The S&P just 500 just did something it's only done seven times ever. The S&P 500 has fallen by 19.4% or more only seven times, going back to 1923. The index usually bounced back significantly in the past after a big sell-off. One important takeaway for investors is that the stock market goes up more over time than it goes down. Mm. The steep decline of 2022 isn't nearly as common as you might think. Close to 100,000 Americans alive today are at least 100 years old. That means they've lived through 17 or more recessions. Close to 100,000 Americans alive today are at least 100 years old. It's interesting. Uh, they've lived through 17 or more recessions. They've seen a minimum of 18 US presidents in the White House. But there's at least one thing they haven't experienced as much as you might think. The S&P 500 just did something it's only done seven times ever. Surprisingly rare decline. The S&P 500 ended 2022 down 19.4%. With such a steep sell-off, few investors made money last year. However, a decline this big is rare historically. It's only happened seven times since the predecessor of the index was created in 1923. Technically, the S&P 500 as it exists today was introduced in 1957. If we only focus on the period since then, the index has declined by 19.4% or more only four times. Some might be surprised by just how infrequent such as a major S&P 500 drop is. That's likely because we've experienced three of them in this century. In 2022, after the dot-com bubble burst, in 2008, during the Great Recession. They won last year. Wow. So so 2022 dot-com bubble and 2008 during the Great Recession and last year. Okay, so it's an infrequent issue. I get it. But looking over a longer period, these huge falls are uncommon. The most recent S&P 500 decline of at least 19.4%. The 20th century came in 1974. Encouraging news for 2023. Investors could also have some encouraging news for a new year. After last year's steep drop, based on history, a bull market could be on the way in 2023. In 4 of the 6 times before 2022 that the S&P 500 fell by 19.4% or more, the index jumped by at least 23.5% in the subsequent year. There is a clear big bounce after bad year trend. The only 2 years when there wasn't big rebound were 1930 and 1931. The U.S. was marred in the Great Depression back then. If we limit our horizon to World War II and afterward, the story is really positive for the S&P 500 after a major decline. We can even throw out the major part of that statement. Between 1940 and 1921, the S&P 500 ended the year with a decline 23 times. In all but 4 cases, the index rose in the following year. The average increase in the year after the S&P 500 fell was 12.8%. Important takeaway. To be clear, there is no guarantee that S&P 500 will climb higher in 2023. That disclaimer you see on mutual funds that past performance is not necessarily indicative of future results. For some, to that effect, it's true about the stock market in general. However, there's important takeaway from looking at the historical performance of the S&P 500. The investors should take to heart the stock market goes up more over time than it goes down. Sure, the S&P 500 doesn't represent the entire stock market. The index only consists of stocks of 500 large companies traded on U.S. exchanges. There are thousands of other stocks that are smaller or traded on other exchanges. However, the S&P 500 has a high correlation with the total stock market. Any lessons gleaned from its history are usually applicable to stocks in general. Some investors could be inclined to avoid stocks after experiencing big losses in 2022. That would be a mistake based on what we've seen in the past. Steep sell-offs truly are rare. So we probably won't have to live to be 100 to see the S&P 500 reach new heights. Okay, I'm getting really tired. I'm gonna see you tomorrow and happy Wednesday night. Okay, bye bye.